Now I'll be speaking about the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, which is the Liquidity Adjustment Facility, stood at a surplus of 70,000 crore on a daily average basis since the last MPC meeting in December 2025. There has, however, been an uptick, I may mention, in February, and now it is almost 2 lakh crore rupees. The Reserve Bank undertook several measures to provide durable liquidity in December and January based on assessment of systemic liquidity and its outlook. We announced and undertook further durable liquidity augmenting measures in the second half of January and February 2026. In response to the cumulative 125 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks has declined over this period till December, for which we have data till now, by about 105 basis points. I may mention that the interest rate effect is 94 basis points. Similarly, the weighted average domestic term deposit rate on an average on fresh deposits declined by 95 basis points. This decrease on an outstanding deposit basis is 41 basis points over the same period. Coming to money markets, especially for CPs and CDs, that is commercial papers and certificates of deposits, the rates tightened in January 2026 after softening till December as a result of moderation, as a result of various factors, including moderation in surplus liquidity, excess supply from bunching of redemptions in CPs and CDs in January, and then there is always the year-end effect in the last quarter of the year. G-Sec yields mirroring global trends have continued to harden over the last 8 months due to a host of factors. Going ahead, the Reserve Bank will remain proactive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy and to facilitate monetary policy transmission. Liquidity management would be preemptive, with sufficient allowance for unanticipated fluctuations in government balances, changes in currency in circulation, and forex intervention, etc. I'll now talk about financial stability. The system-level financial stability parameters related to capital adequacy, liquidity, asset quality, and profitability of scheduled commercial banks continue to remain robust. Similarly, the system-level parameters of NBFCs too are sound, with adequate capital position and improved asset quality. As per latest available data, credit from all sources, it has picked up. It grew at 13.8% as compared to 11.6%. A year ago, it had even come down to 9% in May. Bank credit too recorded an uptick in recent months. This growth is supported by sustained lending to all sectors, particularly retail, services, and MSMEs.